So what we want to talk about today is exchange of property, which is essentially, when you get rid of one thing and bring in a replacement property. And when I was looking through the reading and the problems and things, I thought, the best way to cover this material, I think, is just to look at a couple of examples. And so I'm going to walk through the exercises that are on the syllabus. There's 5.7 and then 8.2, and just annotate them and augment them with some comparisons to the baseline. So here's exercise 5.7. The scenario is basically this. We have a building destroyed by a tornado. We have the details about that building from a tax perspective. Then we have the insurance company paying up and saying, okay, you had insured the building, here's your money, and then they build a new building for $400,000. Okay, and so important to note that this happens in 2010. This happens in 2010. And this happens in 2011. Okay, which may cause some complications. But I thought first what we should do is look at what if there was no tornado. So what if they just sold one building and bought another one? Okay, what would that look like? Well, it would look like this. So we would have a UCC schedule for the building, and it would have an opening balance in. So we've got the CCA class is 3, so class 3, which is 5%, and so the opening balance in that would be $221,000 in 2010, and then we would have this sale, and we would remove the proceeds because it's lower than cost by $5,000. And then we would look at that and we go, okay, well the sum of those two things is negative $74,000, and so we would have recapture of $74,000 because it's the only asset in the class. The class is now empty, and that's it. Then we would move on to 2011, and we'd say, okay, in 2011 they have this new building. So new building, but it actually goes in a different class. So it will go into class 1 because it's a non-residential building, and so it will go into a special class for non-residential, which gets a rate of 6%. Whoops, 6%. And so the addition of this adds $400,000 to the class. Okay, and then we have the half-year rule, so we hold out the half of $200,000. So this is what we did before, right? So we're just kind of recapping or going back and doing what we did before. So the UCC for CCA would be $200,000. We would take the CCA at 6%, and we would get $12,000. We would put back the half-year rule back in, or the half-year portion back in. That's $200,000 going back in, and that gets us to an ending balance of $388. Okay, so that would be the story if we had just bought and sold these things. And so what does that mean from an income perspective? Well, or from a taxable income perspective, it means that we had $74,000 in 2010 being taxed, and then we had $12,000 being deducted in 2011. Okay, so this is what we call a voluntary. So you chose to do it. You bought one and sold another. What the tornado does to us is it imposes upon the company an involuntary disposition, meaning you didn't really have a choice. The tornado came and took it away. So here's the difference, and here's why this is really the answer to the question as asked in the textbook. And so we'll just do it as a comparison. So the first thing is the opening UCC is exactly the same. But what we do here is instead of having the proceeds, so it's still lower of cost than proceeds, so this number is here, but what we get to do, because it's involuntary, is we get to reduce by a number, and that number is the lesser of two numbers, the recapture that will result and the replacement cost. Okay, so what they're saying is we're going to not have you have a income inclusion this year. So in our case, this number is 74, and this replacement cost number is much bigger. It's 400. So this is the lesser of the two. So we get to reduce 295 by 74, and that gets us to 221. Okay, so that's what is removed from the pool. In the voluntary, 295 is removed from the pool. In involuntary, it is 221. So that means our balance is 0 again, but there's no recapture. The recapture has been delayed, or as we'll see where it ends up. Okay, so then we move on and we set up this new building, or we build this new building, and it goes in a new class, and which has a 6% rate. Okay, so that's all the same. So the opening balance is 0. We bring in how much? Well, we don't bring in this. We bring in this minus, so $400,000 minus the delayed recapture. Okay, so what you did not pay tax on because of this involuntary rule reduces your cost, and therefore reduces the amount of depreciation that you'll be able to take over the economic life of this thing. Okay, so then everything else stays the same. We've got the half year out, so we take half of that, that's 163, which leaves 163 for UCC, and then we take the CCA on that. Whoops, that's one too many C's. CCA on that, and we get 9780, which gets us to a balance of 153. Let's put the half year back in right now. So half back in to be consistent. Half back in of 163. That will get us to a balance of 316,220. Okay, so the income statement impacts here, just to make sure we understand, we're getting less deduction in 2011, but we are getting no recapture, so no recapture recorded in the previous year. Okay, so all it's done is it said, you know, at the end of the day, that what's hitting the income statement is all the same, because you're going to be able to deduct less here. In this world, you were going to be able to bring in $400,000. This world, you're not bringing in that 74 that we've delayed, so we're just going to basically spread out that income statement impact over the life of the new building. So a couple of things to note. One is, in the real world, this would involve amended returns, because they would have already filed. So I'm just going to scroll back up for a second and show you the facts again. In 2010, they get these proceeds of $295,000. So in receiving those proceeds, they have a taxable event, and it looks like they've just sold this building before the new one is constructed. And so their 2010 tax return, as originally filed, would have recapture on it, and they would pay tax. Then they would go back after everything settled in 2011 and file an amended 2011 return. Okay, so it's important to note that that's how it would be operationalized in the real world. For our purposes, we can use our backward-looking crystal ball and say, okay, we're just going to look at the net effect, because this, what we've looked at in purple here, is the net effect of all of the amended returns. This is what each year's tax return would end up showing. Okay, the second thing that I want to note is that it is okay that these ended up in different classes. Okay, so you look at, we replaced, the tornado came and took away a class 3 asset. we replace that with a Class 1 asset, and that's okay under these rules. Okay, that's also important to note. Moving on then to exercise 8.2. It's a similar situation, but not exactly the same. So we'll pick up a couple of different facts or aspects of these involuntary disposals. So here again, we have a computer destroyed by fire. Got the facts on that. Then we have they have to rent something because the insurance company disputes it for a while. So important to note here that this happens in 2009. They continue to rent 2009 all the way to 2013. They get their insurance proceeds in 2011, and then they finally buy the new computer in 2013. So what this exercise is trying to get across is a couple of additional facts. One is, so let's just highlight here what it's trying to do, and that is this. So the insurance proceeds, this is when the disposition is considered to have happened. Okay, so you'll see in your textbook, I don't have a page reference for you, but there are basically 5 dates at which the disposition is considered to have happened, the earliest of which, so in this case it's this one. And the other thing too is this 2-year lag. So that is a horrible bracket. This 2-year lag here, between here, is, we have to be careful because in order for these replacement of property rules to apply, it has to be less than 24 months between the time of the involuntary disposition and the purchase of the new computer. So they end up being on side of this, and so they qualify, but they get pretty close. So if it's not 2 years, then the involuntary disposition is, you can't go back and file. But this company can. So let's go and look at, again, what if there was no fire? So what if there was no fire? Meaning, what I'm really asking here is, what if it was voluntary? So because we want to, why am I doing this? Because we want to look at the baseline, just like we did before. We want to use this as the baseline so that we can understand why the treatment under involuntary is the way that it is. Okay, so let me just rewrite that a little more nicely. So under voluntary, we will have 2009 opening balance. So this is the class, they tell us, class 10. Oh boy, everything's disappearing. Voluntary, class 10 at 30%. Okay, so our opening balance will be 17,150. We'll take CCA on that. No half year rule because we're entering later in the life. They didn't just acquire it. Okay, and then so we will have a balance to go forward of 12,005 for 2010, and in 2010 we will take CCA on that of 30%, and we will get 3601 to get us down to 8404. Okay, so just a couple of things to note here too is that, so this is reducing income, right, and reducing income. We also have, just to note, this rent being paid, but all we're doing here is rent on this replacement computer, but that has nothing to do with the whole replacement thing. Okay, so those are costs that are being incurred. The rent is being expensed. This is in addition to that. They still. Until this thing is replaced, it's considered to be owned, and it continues to you continue to take CCA on it, even though it's been destroyed. It's ash on the floor. It stays in the UCC pool until it's replaced. But in this case, there was no fire. So for our baseline, what we're doing is we're saying, okay, they got this computer sitting there. They're not using it. Do they continue to depreciate it? Well, they either do that or they throw it out, at which case they'd have a terminal loss. So we'll just consider that they continue to take CCA on it each year, but they're renting this other thing that's actually this other computer time that's actually doing the work. Okay, just to set the scene. Okay, so now this is 2011's opening balance. And then 2011, they sell this thing. Okay, so they sell and they take out of the pool the lower of cost and proceeds. And when they do that, they of course get to a negative balance of 41,596, and they have recapture. Okay, so the recapture is that amount, and that gets our balance down to 0. Okay, and that's the 2012 balance sitting there. Okay, for this class. They also, we need to note, although it's not particularly important for us here, but they also have a capital gain, right? So let's just do it in the margins over here. There's a capital gain on this thing. So it's rare. We said it's rare, but they actually sold this for more than they bought it for. So the gain is 60, their proceeds, minus 50, their cost, that's 10. So they would have a taxable capital gain of $5,000 to go to income this year. Okay, so we'll circle it in red. That would also go to income. So recapture would increase income, and as would the taxable capital gain. Okay, then just to continue this scenario, in 2012, all they do, they don't buy the new thing, the new computer yet. They just continue to have this rent that they were doing before, but that doesn't affect the UCC schedule. Then in 2013, they buy this new computer, but it goes again, like we saw in the previous exercise, it goes in a new class with the higher rate. But the fact that it goes in a new class under voluntary, which is what we're doing right now, that's, who cares? It's in a new class. So class 10 has a 0 balance. This one started with a 0. We add the purchase of $70,000. We do the half-year rule. So take out 35, leaving 35, calculate the CCA of 55%, so that's 19,250. Put the half back in, and we get an ending balance of $50,750, if my math is right. Okay, so that's the baseline scenario, as if everything was voluntary. So they just stopped using this computer, they rented another one, they finally went out and sold the old one, then they bought the new one 2 years later. That's what this would all look like. So now, let's go back and look at, so let's see, I don't know what color we used before, but let's use purple for this. So involuntary, let's just do as a comparison. Okay? So in the involuntary, everything will be the same up until here. Okay, so I won't bother rewriting it. So this is just the same. Okay, then in 2011, when they sell, similar to what we saw before, the lower of costs and proceeds comes out, but we get to reduce by the lesser of recapture. I'm going to shorten that if you don't mind. Recapture and replacement cost. So rep cost. In this case, it's the recapture again, so it's going to be 50. So it's 50 minus our recapture. That gets us down to, not surprisingly, I would hope, 8404. That's our reduction. That's our deemed proceeds, we call it. So our deemed proceeds are 8404, getting us down to a 0 balance in there. The other thing, though, that we have to note, we'll just kind of do in the margins here, is the capital gain. So remember, there's in the baseline, there's a capital gain, a taxable capital gain of $5,000. Well, what happens over here? Well, the capital gain in this case is deemed to be half times the lesser of two numbers. The first number being, of course, the capital gain. The other number being proceeds of disposition minus replacement cost. Okay, interesting. So the replacement cost isn't going to be known for 2 years from now. So again, I want to remind you that in the real world this would be done on an amended return. Their 2011 return would have been filed with $41,000 of recapture and a $5,000 taxable capital gain. Now they're coming back. Now we're looking back from the future, and they're going to file an amended 2011 that's going to have this number. So since proceeds are smaller than replacement cost, this number, all of this, is 0. And so the lesser of those two numbers is 0. So their capital gain is a half of 0, so it's 0. Okay, so just to note here, let's make this a little bit clearer. For 2011, on the amended return, the taxable capital gain is 0. Recapture, also 0. Okay, so what ends up happening then? We go forward into 2012, nothing happens. So 2013, same thing. We have a new asset, new class, so that's fine. The replacement can go into a different class if it needs to. And then what we have to do is, just like we did before, we are going to reduce the proceeds by two things this time. We're going to reduce the what comes into the pool by two things. So it's going to be this less the deferred gain. So the gain, that gain that we did not recognize, and the deferred recapture. Okay, so that's going to be 70 minus 10. So not the taxable capital. So notice gain, not taxable capital gain. That's going to be 70 minus 10 minus 41. Let's write it out. 70 minus 10 minus 41, 596. Okay, so that's going to be equal to 18. What happened here? 18,404. 18,404. So that's what's going into our new UCC pool. Okay, so in the baseline it was 70. Now it's 18,404 that's going in. So then everything else mechanically is the same. The half year hold it out. So that's going to be 9,202. That's going to give us our UCC of 9,202. That's going to give us CCA at 55% of 5061. I'll always do that. We're going to put the half back in of 9,202 to get us to an ending balance of 13,343. Okay, so you compare these numbers, and that means in the future years there's 37 roughly thousand more dollars to be taken to income in the baseline than there is now. So what's that difference? The difference is that when they go back and file their 2011 amended return, there's no recapture and there's no taxable capital gain. So basically what they're getting to do is defer the tax. And how's it being deferred? Well, it's reducing the UCC that comes into class 50 when the new asset is bought. And therefore what's going to hit the income statements in future years is going to be smaller on the negative side. So the expense that's going to hit the income statements in future years will be smaller, but so was the income in 2011. So it all evens out in the end. It's just the timing of these things that matters.